What's up, investing legends? Today we welcome Josef Schachter to the program. Josef's career spans decades on both the buy and sell side of the energy markets, giving him a front row seat to multiple commodity supercycles and the macro forces that drive them. After years in institutional roles, he launched the Schachter Energy Report, a subscription-based research platform designed to give individual investors institutional-grade insights into oil, natural gas, and the broader energy sector. Today, Josef leads a growing team of analysts, helping investors navigate one of the most volatile and potentially lucrative sectors in the global economy by combining deep macro research with actionable investment ideas across public energy companies. We kick off today's episode with Josef's background and how his experience through past cycles shaped the way he analyzes supply, demand, and capital flows in the energy markets today. Later, we dive into the current setup for oil and natural gas, why underinvestment and global demand are setting the stage for a potential multi-year supercycle, and how geopolitical events are impacting pricing in real time. To wrap up today's episode, Josef breaks down where the biggest opportunities are right now, from Canadian energy markets to natural gas plays, and how investors can position themselves to capitalize on what he believes could be one of the most powerful commodity cycles in decades. So if you're looking for a clear framework to understand energy investing and how to identify opportunities before they become obvious to the broader market, this episode delivers perspective from someone who has studied and invested through multiple full cycle environments with a long-term disciplined approach. So without further ado, everyone, let's welcome to the program, Josef Schachter.
Welcome to the Investing Secrets Podcast.
Any questions for me before we get rolling?
No, I think, you mentioned, your reach. If you'll send me the link, we'll put it on our website as well, so that may get you some more exposure. The only thing I would want to do is compare, is bring out, Canada being an interesting investing location, simply because our basins are newer than the U.S. and we're now starting for the first time to be friendly to the energy industry. We had governments in Ottawa that were very unfriendly. So Canada is waking up. And I'm using for an analogy, I'm saying we're in the third hole of a golf course. And for the bull market in energy, and so there's still a lot of game left, and the stocks are really, really cheap. They've had a good run, no question about it. Some have doubled or tripled, but historically, companies go from 2-3 times cash flow on depressed commodity prices to 8 to 10 times cash flow on peak commodity prices, and so we're still very, very cheap. And then on a reserve basis, we're sitting near PDP, proved, developed, producing, and then you have something called proven, and then you have proven plus probable, and at market peaks you trade at 2P, at bottoms of markets, which we were at April in 2025 at PDP. So there's lots of, every time you're going to have rallies and corrections along the way, like you do in everything, and so we can talk about that and, look at gold, it's having a bit of a correction now. Is it the end of the bull run? I don't believe so. I think that government debt is not going away, and, and the financial system has got risk to it. And, will we need $10,000 gold, $20,000 gold? Who knows? That's not my area of expertise, but I respect the people and the arguments they make that you need to have something to back up, countries' finances and, precious metals. China is buying the hell out of it. Russia owns a hell of a lot of it. And, Canadian government sold all of theirs. That alone is a good reason to buy gold.
Well, shoot. I mean, that's just, that was so great, Josef. We're just welcome to the vault. Thanks for stopping in. And I'm really excited to chat with you about the energy sector and energy markets in general. Obviously, you've cut your teeth on the buy-sell side, and now you're running Schachter, the Schachter Energy Report. The overall theme, I think, that I'm kind of gathering from just reports and whatnot is that we are headed for like a surge, right, in pricing, and I'm wondering, geopolitical issues aside, what the main, and maybe that is the key driver, right? But what are some of these other drivers that are that are driving oil prices up right now?
Well, you got to look at it from the point of view that the world is going to need more copper, more lithium, more nickel, more aluminum, all of those raw materials if we're going to have the AI world, data centers and, electrical grids upgraded. And that's coming from the third world. That's going to come from South America. It's going to come from Africa. It's going to come some places in Asia. And for those countries to put those mines into production, they're going to need a rate of return for the country. The companies putting money up have to get a good rate of return. The people working there need to have a better quality of life. Many of them, there's 2 billion people out of the world that don't have running water or electricity, and they're mostly in the countries that we need the product from, the raw materials for this growing world. So they're going to want running water and electricity, and they're going to want to drive, instead of bicycles, they're going to want to drive, cars and trucks. Maybe right. Not, the kind we drive in North America, but even a small CC that can take them from location to location is what they're going to want. So the reality is the demand growth right now this year, we're going to probably consume 106 million barrels a day of crude oil. I think we're going to be 112 to 114 in the early part of the next decade. The OECD will have a decline, but the emerging world will have all of the increase. And that is really the basic story. And so to bring on more oil, the industry has to spend more money. To right now, the industry spend doesn't even replace all of the decline. So if you have, let's say, a 7% decline rate on that 106 million, that means 8 million barrels have to be found of new oil every year. If we're lucky, if we find 3 or 4. So half of what we need. And so the reserve life
in additional barrels,
new capacity. And our reserve lives are shrinking. And so the industry has been spending money on NCIBs, normal course issuer bids. They've been paying dividends, paying down debt, and they're not growing their production for the most part. And that's really the key. We need to start spending more money, and the only way it's going to happen is not at $60. You're going to need an 80 or 90 long-term commodity price to attract the capital to grow. Because you're going to need drilling in the Gulf of America. You're going to need to be, tier 2, tier 3. Permian inventory has to become tier 1. The oil sands in Canada, the heavy oil opportunity in Wyoming, offshore East Africa, West Africa, sorry. There's so much opportunity, but you're going to need a lot more capital, and the capital has to get a rate of return. And that's really the story. Today, the industry is not getting, prior to March 1st, let's go back. Prior to March 1st, when we were in the $60 for WTI, the industry was not making an adequate rate of return to spend more money in the ground. You had Harold Hamm from Continental Resources saying, I'm not drilling any Bakken wells in North Dakota because I can't make any money. When you get business people like that saying, no way, does it make sense for me to drill? That's the problem.
So, by the way, I will be the first to admit when I am, uneducated or just simply not as privy to the intricacies of a certain sector. And energy is certainly one of those sectors that I know very little about. So forgive me if I'm asking these very basic questions.
Look, you're a consumer of energy. You drive your car, you heat your home, so you are a consumer of energy.
Yeah, that I am, and I'm sure I consume more than a lot. So, what I'm hearing you say then is that number one, the biggest driver of prices right now is the need to increase capacity, right? So maybe that's not the right word, but we need to increase capacity, and to increase capacity, obviously to dig or to drill, to start the drill. I know that's the most expensive part of the whole thing, right? It's to actually get it set up and find in the places that you need to. I watch Landman, man. So that's about all I know. So you gotta
get the land. You gotta do the G&G workup. You gotta find out where you think the oil's going to be, and then you take the risk. The lie detector of the drill bit tells you, did you find oil or did you not find oil or gas?
And so that is probably the most time consuming and most expensive part, right? And
Correct.
so to do that takes a lot of time, money, and the rate of return at which barrels are currently selling at is not enough to justify that. Is that what you're saying?
Pre-March 1st. The war changed everything. With $94 oil today, if that was sustainable into year end, that would be enough. But again, it's a war premium, and when the war ever ends, that premium should dissipate. As historically, after Russia invaded Ukraine, it popped to 120, and then 3 months later, it was back down to what it was before the invasion.
I see. Okay, so wartime creates a premium, but only it's like a shock to the system, knee-jerk reaction, and typically comes back down. What you're saying is that to sustain the level of growth that we need to satisfy these emerging markets, or like the emerging worlds, there's going to be a need for sustainable, or like a longer term growth of the price for oil, like the cost per barrel.
And natural gas, correct.
Got it. Okay. And what you're saying too, Joseph, is that like this need potentially could continue to grow for quite some time, right? Like what is the 5 to 10 year trend based on your analysis, like in terms of like growing need in these emerging markets?
Well, we've had two major super cycles in my career. 1974 to 1981 was the time when underinvestment at the beginning, and Japan became the big economic engine. We all started buying Toyotas and Panasonics and Sonys, etc. And they became a bigger user of energy, and at the margin, because there was a new entrant buying a lot of oil, that pushed the price up. Then you had the 73 war. Then you had the Shah of Iran being deposed. So you had a lot of political issues that affected oil. But we went from under $3 to 36 from 1974 to 1981, and that caused a cycle where the price of oil went up 12 times, and the energy stock indices went up 15 times. So from 74 to 81, 15 times on your money is awesome. Then we went into a period where we had too much oil, and we had a dead period where it was a trader's market, not an investing market. I like investing markets, not trading markets. So in 1999, China said, oh, hey, why don't we allow capitalism under a communist system? They were consuming 3.5 million barrels. And by the time you got to 2008, they were consuming 14 million barrels. Again, new entrant, big use of energy, pushed the price up because it was not enough. And now, then we went into a dead period again. And then 2020, post-COVID, we started realizing that, AI was real. We realized the grid was not sufficient. The electrical grid in many places were brownouts. And if you did want to have data centers, we needed more electricity. Does it come from natural gas? Does it come from small modular reactors? Does it come from solar and other renewables? And all of a sudden, we realized that we're going to need raw materials, which are only going to come from the third world. A majority come from the third world, the new product. And that's where the story comes together. And I think this started in 2020, and I think it'll go to 2032, 2034, before we bring on too much. You put 10 new copper mines into production, you put 20 new lithiums, you put EV battery manufacturing everywhere, you build massive solar facilities in these countries. All of a sudden, you overcapitalize an industry, and you know what happens when it gets overcapitalized. The cycle's over.
Mm-hmm. Mm-hmm. You're predicting another, call it like 5 to 7 year run up before that happens.
Correct. That's why I joked with you when we started that we're on the third hole of a golf course, and there's lots of golf still to play.
Yeah. Well, when we first started too, we briefly mentioned Canada, and obviously you're located in Canada, correct?
I'm in Calgary, Canada.
Yeah. So you believe that that Canada is ripe for a massive run up. Walk me through the thought process there, and like walk us through like at a high level what the opportunities are for investors in that market.
The basins in Canada and the States are attractive. You've had Texas, of course, being unbelievable with the Permian and the Eagle Ford and offshore in the Gulf of America. We have energy areas in Canada. Alberta is like Houston. Calgary's like Houston, so we have a lot of oil in Western Canada. So Saskatchewan, Alberta, and Northeast BC are the energy basins for Canada. We also have offshore East Coast Canada, Hibernian oil there, some natural gas. And so the opportunity on these resource basins where you have in-place oil, it requires, okay, what's the price you need to unlock that oil and bring it to production? And then the other thing is transportation. How do you get it to market? So the United States, if you're in Texas, you've got an easy market because you just go to the Gulf Coast and you can ship it away. And you have 20 BCF of export capacity for LNG, and that was a business that wasn't around 10 years ago. And they're talking about with new facilities going to 30 BCF a day by the end of the decade. Canada had nothing 10 years ago. We had nothing even 6 months ago. And now we have 2 BCF, one facility on, and we're going to bring on 4 more to a total of 6 BCF. That's in the context of 18 BCF. So 6 on 18 is a pretty good growth rate. Plus you have the decline rate, as you produce oil or natural gas, the pressures go down and you have less production, after a period of time, from the initial flush production. And so we have an opportunity here for a lot of upside growth, be it oil, be it liquids, be it natural gas. And we are growing. It's profitable. We have export markets now to Asia. We sell a lot to the United States. During your winters, you need a lot of Canadian gas, especially in the Midwest, where you can get pretty horrible cold conditions. And then we ship a lot of oil down to your Midwest refineries and to the Gulf Coast because you need that for your refineries process heavy crude, and that heavy crude is what creates the gasoline and all the product, diesel, jet fuel, all the things that we consume that get produced from asphalt. What gets produced from barrels of oil. So
you used a term there that I'm not familiar with. What is BCF?
Billion of cubic feet. So there's molecules of natural gas. There's a million cubic feet. There's 1,000 cubic feet, million cubic feet, billion of cubic feet. And so if you check out, Google, the US LNG, the number they use on the big base, it's like when you use kilowatt assets or gigawatts or whatever, for computers. BCF is the one that the industry uses, which says it's a big size.
Got it. Okay. So, and just to walk back to what you said. You said Canada 6 months ago didn't even have or had 0 BCF.
They were building the facility and it wasn't in production, and it's ramping. It ramped up, early this year, and now in March it's now producing 2 BCF.
Got it, and that's in comparison to how much is you compared it to 18 BCF, and so now I got lost there.
Our Western Canadian Basin produces 18, and we move it through pipelines, and we consume it in the province. We ship it to the States. We put it in storage when it's not needed, and now you've added 2 BCF more of incremental demand. By the end of the decade, you're going to have another 4 BCF of incremental demand, so that's going to be 6. On a base in Western Canada that can only produce 18 right now. So if the 18 grows from internal growth, population growth, more electricity, data centers, then you also add in 6 BCF of exports. That tells you that you've got a pretty good growth industry on that natural gas side.
Got it. Understood. And then for comparison, right? Like what is you're saying that's just in Western Canada?
Correct.
Okay. For comparison, how does that compare to like the output in, say, the U.S.?
The U.S. numbers, I believe, are about 130 BCF in terms of production, and that's gone up because of that 20 BCF export market. So it might have been 110, now it's 130. and it's growing because of the demand from LNG. Because remember, an LNG cargo, the cost is to refrigerate it, put it on an LNG tanker, take it off to Europe or Asia. Well, if you're taking it to Asia, you're getting $15 US an MCF. The domestic price in the United States is $3.14. So if you add on, the cost of processing, you might get to $10. And if you're getting 15, that's a nice extra margin for the producers. If you go to Europe, because of the Qatar attack on the Pars field, which is shared by Qatar and by Iran, that cutoff and closure of that biggest natural gas field in the world drove TTF prices, which is the European price, to $61 an MCF. So think about it. You're getting $3 in the States, process it, ship it off to Europe, you get 61. Ship it off to Asia, you got 15, maybe 20, depending upon the shortage, which countries. And if you sell it in the States, you get $3. So at $3, you make a little money. If you sell it at 61, you're pretty golden.
Got it. So the export market is very very lucrative.
Correct.
Got it.
And Qatar
Understood.
and Australia and other countries usually had it. Russia was a big producer, before they invaded Ukraine and made a lot of money. And then Europe pushed Russia out, and all of a sudden there was a shortage, and that's when the American industry took off, and the American industry met a lot of the needs in Europe. But right now, with Qatar being shut on, which sold a lot of their gas to Europe, the Europeans are panicking that they may not have enough for winter of 2026, 27, and they're buying up cargoes at $61, which is insane.
And now Canada is getting into this market as well, or trying to penetrate.
Yeah, but
the
our
European
market's
market.
going to be into Asia because BC is on the west coast of Canada, and so the transportation from Western Canada to Japan or South Korea or Thailand or Vietnam is shorter than the distance from the Gulf of America to Asia.
Right. That makes sense. So you're being on the West Coast, those exports are going to go to Asia versus, makes sense. Makes sense. So
the travel distance from Gulf of America is longer. So the day rates for the LNG carriers have gone up sharply 5 times because of Qatar and other area problems. So they used to be getting, I think it was $60,000 a day. They're now getting $300,000 a day for the ship owners for providing those ships to carry LNG around the world. So the Greek ship owners are making out like bandits.
Yeah, sounds like it. So I see a prediction here that we're thinking oil could get up to $150 a barrel. The longer
the war lasts, today the price of oil was at 100. It was 118, I think, in Brent. And then the United States, President Trump was with I think the president or prime minister of Japan, and they agreed that they would provide ships to open up the Straits of Hormuz. So Britain joined in, I believe France and a few others joined in. So that lowered the price of oil because people started saying, oh, the war is going to end quicker. I don't believe it will. The war doesn't end, in my book, until Iran has no ballistic missiles to fire at their Arab neighbors on the western part of the Persian Gulf. They don't have any drones to fire at them to blow up their facilities. They don't have the ability to attack any shipping in the Persian Gulf, and they don't have any weapons to attack Israel. They don't. They have enormous amounts of weaponry, and every day you see, if you watch CNN, there's been attacks here, attacks there, ballistic missiles with cluster bombs. So until they have lost any ability to attack their neighbors, I don't believe the war is over. And then the other issue is, does President Trump want to get rid of the nuclear weaponry, nuclear material that can be turned into weapons pretty quickly? And that was the reason that they were worried that they were imminently ready to do that.
Right.
And that is still an issue that has to be resolved.
Yeah. It's very interesting times, and it's fascinating. Well, I mean, look, like this isn't the only sector that's directly influenced by the war. But I think that oil specifically is probably the most heavily impacted sector, as it pertains to, geopolitical issues and wartime. I can't think of another sector that's more impacted, right? Than
with
oil.
The Straits of Hormuz closed, you got to take into account a couple other things. Sulfur comes as a byproduct of sour gas, and sulfur is needed for fertilizer. So the fact that is closed and that's not around, fertilizer prices have doubled, urea prices have doubled. We're now in the time when farmers start planting. If the cost of everything for the fertilizer doubles, they can't afford maybe, which means if they can't afford it, then the harvest quality and the size of the yield goes down. So this issue not only affects, crude oil, and natural gas, it affects the food chain. And that is the wild card now, because the longer the war lasts, the more difficult it is for farmers to plant and get a good harvest in 2026. I
see. Yeah. That's a totally separate subject. It's like,
but all based on the war and
right.
Supply chain issues of the oil and gas industry.
So to switch gears a little bit, right, Joseph, because we've been talking kind of high level energy. It sounds like your report, the Schachter Energy Report, is the investor's guide, right, to making sound investment decisions as it pertains to the energy markets. Yeah. Yeah.
What we try to do is we have a weekly piece called Eye on Energy, which is our macro research piece. It comes out on Wednesday. We have in there the EIA data from the weekly petroleum report, the EIA natural gas data, OPEC monthly data. And then I go over what the supply and demand issues are, what's the positives and negatives for oil, so you can hear the balance there. And that piece is very good for people to decide about investing in the sector. And then in the SER, we talk about the areas to invest, the service sector versus oil versus natural gas versus liquids. And we cover 32 Canadian companies. So we have many of them that are interlisted on the United States. They're on the big board or they're on the OTC. So if you want to invest in Canadian companies and living in the United States or wherever you are in the world, we provide you the interlistings, be it the AIM in London or the London Stock Exchange or the Frankfurt or the U.S. exchanges. So people have a chance to know that the Canadian companies are interlisted around the world, and they can then decide if they want to, from the story, if they like it, that they can buy it easily in their brokerage accounts wherever they are.
Understood. And as it pertains to the forecast, right, for investors who are interested in energy and specifically, oil, natural gas, you mentioned Canada as a big opportunity. Where else, or like what other things or niches in oil and gas, like, should individuals be keeping a close eye on?
Well, there's so many ways to invest in it. If you're a conservative investor who needs dividend income, there are lots of names that pay 4 to 6% dividend yields. And if you buy them at the right time, you could get 15, 20% capital gain. So we cover a group of them called conservatives. Then we have a group that we call the growth, where they're drilling and spending more money that they can grow their production. And then we have the entrepreneurial ones, which are smaller companies for the most part. And that's where if they're doing an exploration play and they're successful, then all of a sudden you can get the massive upside. So what we're trying to do is meet the needs of three different client groups, and we've been able to do that quite successfully. Since we started the product.
Are all of these public companies, Joseph, or are some of these?
We only cover public companies. So they're on the Toronto Stock Exchange, they're on the Venture Exchange of Toronto, they're on the NYSE, they're on the OTC market, they're on London, or Frankfurt, and we put that on the cover of our financial highlights. When we write up each story, we put where they're interlisted.
What are the pros and cons of investing into private companies, private oil companies, whether it be in Canada, US, right, versus public?
If you're a large, private equity firm and you can invest, $100 million in this one, $100 million in that one, then you can diversify enough that if one fails, your fund is still going to do well. For an individual, that's not so easy, and the liquidity becomes an option. If you're raising a pool of funds in a private equity, you have lock-in provisions and you have redemption provisions. For an individual, if you have a $5 million portfolio, to put $1 million into private equity doesn't logically seem right. You'd rather put, first thing, that $5 million, you want banks, you want consumer products, you want technology, you want the whole data, the suite of ideas, precious metals. So to put $1 million in one private equity story, and they're not going to let you in if it's a small amount. They're not letting you in for 10 grand.
Sure. Yeah. They might let you in for 100 or 250, but definitely not for 10. Yeah.
Yeah. And if you have a $5 million fund, what's appropriate?
Right. I hear what you're saying. So in your mind, the public sector, it's not necessarily that, the upside is greater, what I'm hearing in the public markets, but your risk is lower because you can diversify with less capital per company, and there's higher degrees of liquidity, et cetera.
And you have regular reporting on a quarterly basis, and you have you have access to information. Companies that are public also put presentations on their websites, and they also do a lot of marketing. Let's just say dog and pony shows, and which you don't really have in a private firm.
Makes sense. So your thesis is, unless you've got lots of capital to deploy across various private opportunities, which, by the way, like in my head, I would think of public companies being slow and steady wins the race, right? It's like, hey, we're just kind of putting it into these companies that have quarterly reporting. We know exactly what we're getting ourselves into. Versus private companies where it's, grand slam or strikeout, basically, right? Is kind of
well, that's the when I talk about the entrepreneurial names we cover, that's their mindset. Those are the guys from Landman.
Yeah, exactly. But still public, right? So those companies are still publicly traded.
So while you're taking higher risk for the type of investment, you at least have liquidity and information and access to management, which is not so easy on the private side for individual investors.
Makes sense. When you were on the buy and the sell side, were you mostly dealing with publicly traded companies then as well, or were you
always? I never got into the private world. I never have, and probably never will.
It's like the wild, wild west, isn't it?
There's so much opportunity in the public markets, and I have the advantage of information. And the thing that makes successful investing is knowing your investments, access to management, being able to check out any story, via alternative companies that are in the area. So if a company says we're doing this and we're going to have these wells come on at 500 barrels a day, well, you can go to a competitor in the area that's public and say, are you after this play? I'm hearing there's somebody in the area doing 500 barrels a day, and they can say that's bullshit.
Right. Yeah.
Nobody, the reservoir can only do 200 barrels a day on an IP basis. So you can check things out a lot easier and make quicker decisions in the public market.
Yeah, makes sense. Well, Joseph, we're starting to come up close to time, so I would be remiss if I didn't give you an opportunity right now to let the audience know, where they can find more information on Schachter Energy Report, how they can subscribe if they're interested, and get more information on how to do that.
Just go to our website, www.schachter, SCHACHTER, energyreport.ca. CA for Canada. And the benefit is the Ion Energy will help you with the macro decisions of investing both in, if you want to only invest in U.S. companies as a U.S. domiciled individual, you can do that. If you're in Europe, you can, we give you thematics that allow you then to say, okay, I'm going to buy a domestic company versus going to Canada. But if you want to go to a cheap basin, remember, Canada's the fourth largest producer in the world. The United States is the biggest between crude and NGLs of 23.7 million barrels. Then you go to Saudi Arabia at 10.2, Russia 9.3, Canada 6.1, and then you go to China behind us is 4.2. So we're the fourth largest producer in the world. So do you want to deal with Russia? Do you want to deal with Saudi Arabia? Maybe, maybe not. So you got the U.S. and Canada. So we're not going to be the 51st state, but but we are we are a good neighbor in the bad times.
Yeah,
and the good times.
Oh, that's awesome. Well, that'll be in the show notes and then in the description as well on how to find more information on Schachter. Joseph, this has been great, man, and this has been highly informative. I was actually going to ask you, like, from and you kind of actually answered my question, which is, are there more like thematic kind of overviews that allow people to make decisions outside of just the purview of Canada? And so it sounds like anyone that's interested in energy in general could benefit from this report.
Yeah. The macro side we do.
Yeah.
We spend a lot of time on the macro side, which a lot of firms don't. A lot of them just take the forward curve and say that's their price. We do a lot of work. I get a lot of services on the intelligence side. So I'm really up on what's going on right now with all the challenges in the Middle East. And I think that the input from the macro side can help you make good decisions wherever you live to take advantage of the energy supercycle that we talked about. Which if you're an investor, now is the time to be in energy. If we get to 2032 and we have too much oil and we found too much and we have a lot more pipelines, I may say it's a trader's market. Don't talk to me.
Yeah.
I'm not your guy. But when it's an investing market, which I believe it is, it's like somebody calling you 4 years ago and saying precious metals are going to take off at some point. Here's the kind of companies you want to look for. So they're early in the cycle. And I think gold is not over, and uranium is not over, and fertilizer is not over, lumber is not over. So I think you got to decide to yourself, what do you want to own? The biggest piece of the commodity space is energy. It's the biggest portion of the CRB.
Mm-hmm. Couple last questions here for you, because I'm really curious. So right now, with where we're at a price per barrel versus the 150 plus where we think it could go, from an investor return standpoint, right? What does that mean in terms of like stock prices and like net returns to investors? Obviously, like, by the way, this is not financial advice. Just like, I'm not asking you to whip out your crystal ball and give everyone the answer, but rather an educated prediction on what that means in terms of overall stock growth as it relates to the price per barrel.
I think this cycle is going to be even better than the 99 to 08. Then it was China coming in, as we talked earlier. The growth rate from the third world will be bigger than the China impact. So just pick out any stock that you like If you like ExxonMobil, if you like Chevron, if you like Schlumberger, pick a name that you like, in your market, if it's the States or Canada or Europe or wherever, and look at how the stock did from 1999 to 2008. And I bet you, with corrections along the way, there were 10 baggers. Sure. So the key thing is to take advantage of those corrections when they happen. We had that in April of 2025, from January to April during, the announcement of tariffs, and price of oil went from 79 down to 54. So you want to wait for those corrections to really build positions. I'm right now saying that oily names are relatively expensive and natural gas names are cheap, so focus on natural gas. The other thing is, if you bought a 5% weighted position in April of 2025 in oil, that position's tripled or quadrupled. So a 5% position is now an 18 or 20% position. Well, most individual investors, from a prudence point of view, don't want to have one name that big in their portfolio if they have 15 or 20 names. So prudence says, pull back some of the name, harvest some of the gain, and then have some cash for the next potential investment. So that's what we're telling our people on the oily side, and we're saying the bargains are in the natural gas side.
That's awesome, man. I appreciate the words of wisdom. I'm not going to let you leave the vault, though, Josef, until you leave the audience with one final golden investing secret. Take it away.
I'm an investor, so I look at things not from a trader's mentality of a day or a week or a month. I'm in there for years. So find the right names, do your homework, meet management if you can, do your checking on a quarterly basis, but buy and hold and be patient. And that's the word, patience. I have had 5 and 10 baggers in the prior cycles. I expect I'll get the same in this one. I've already had doubles and triples in this cycle. And the reason is because I'm patient. I wait for those corrections and I add to positions that I like on the weakness. So the word for me is patience.
I love it, man. I love it. Josef, this has been, it's been a pleasure, man. And I'm hoping this isn't the last time we get to connect. I think having you on as a repeat here and in a little bit, just to kind of catch up and see where the forecast is for 2027 would be awesome.
Super. You take good care, and glad I got to do this with you.
Awesome.